Welcome to another episode of Label on Fire, where we share practical tips and insights to help you achieve financial independence and retire early with confidence. In today's episode, we'll explore the world of investing in retirement, focusing on the common mistakes that could cost you thousands and how to avoid them. I like that part.
Welcome to Label on Fire with Label Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Label on Fire.
Let's dive in and we'll make sure your investments work for you throughout your golden years. And first, I want to say hello to Label Sternbach. Welcome back, and thank you again for scaring the heck out of us last week.
Hey, just doing my job.
He is the author of Living with Financial Anxiety and also the author of Authenticity. He publishes a regular financial column. He hosts this show, and you can find him on TikTok, YouTube, and Facebook. You're a man about town. Let's talk about, it's so intriguing, investing while you're in retirement. Do you think that investing in retirement has changed in 2023, sir?
100%. I think that it has fundamentally changed. It has changed significantly. The biggest change is that it used to be that people had the amount that they had in their bonds portion. So when you talk about the 60-40 portfolio, 60% in the stock market, right, 40% in bonds or something else that was saved. Generally speaking, right, you had one of two advisors. You had advisors who were like, we can't really be in 40% in something that's low risk because it's not getting anything or it's actually going negative. So they would go after things that you could call bonds, but were actually high risk, right? So people ended up with very high risk portfolios. So that was option number one. Option number two was people were doing the 60-40 and their assets just weren't growing as fast as they should have, based on what a 60-40 is supposed to do. Now, come 2023, interest rates we've shot well past the historical average for the Federal Reserve rate, which means interest rates are back and climbing. The Fed says they're going to keep going up, which means bonds, right? Investing in individual bonds, right? Or really even bond funds, which have been pretty stable for the last 10 years, those are no longer stable anymore, because the price of bonds is fluctuating so much. So in order to create a stable retirement portfolio, one that has less volatility, so less ups and downs, so that you can take money out of it during retirement and not worry so much, that has gotten a lot more complicated. And what I find myself doing, right, a year or 2 years ago, I was perfectly fine having my clients in. They would say, oh, my 401k is invested in a target date fund. I'd be like, sure, okay, your target date fund is a 60-40, 70-30. It's a good amount of risk. But with interest rates changing and changing so much, I have them separating that out. And I have them going directly in equities for the portion and then investing directly in treasuries or something else that they have available, instead of allowing the target date fund to do it, because the target date funds, a lot of them are taking on excessive risk. And if you look at their growth charts, they went down significantly over the last 2 years, but then they didn't participate in the recovery, which to me is, if you're taking on the risk, then you should have the recovery. Right? Mm-hmm. That is the entire purpose, right? So if you didn't protect me on the downside, then at least help me get the upside. And I can't tell you how many, and it's across the board, whether it's JP Morgan or Morgan Stanley or Primerica, Transamerica, I've seen across the board these managed mutual funds that are supposed to be managing the risk. Very few of them are doing a good job. And all of them are failing on the upside, right? It's like most of them failed on the downside. Few of them are doing a good job on the upside. I literally saw, I think in 30 or 40 that I've analyzed recently, one that was doing a good job. So when it comes to 2023, I think the whole game has changed. You need to take a more hands-on approach. I think that you need to, when it comes to bonds, right? I see people, even professional investors, they're like, oh, let me buy a 1-year treasury. Let me buy a 3-year treasury. I think you need to take a much shorter term approach. And you also need to look at your bigger picture of, okay, what happens if inflation stays at 4 or 5 or 6% for the next few years? What if it never comes down, right? What if 4% is the new normal for the next 10 years? What then? What is your plan? because that's going to affect the bond market, it's going to affect the stock market, it's going to follow a whole bunch of venture capitalists, and they're talking about what's going on in Silicon Valley, where the whole dynamic of what it takes to make a startup has changed fundamentally because of interest rates. So I think that when it comes to retirement in 2023, investing has fundamentally changed. You have to take a more hands-on approach. You can't just have a buy and hold and set it and forget it. You need to really look to the future and say, this is what I think the future is going to be, not this is what did well in the past. It needs to be, this is what I think the future is going to do. And this is investments that are positioned for the future.
So would you call this a precarious situation for retirees or an advantage situation for retirees?
It's precarious in the sense that you can no longer be a passive participant in your retirement plan, right? For the vast majority of your life, being a passive participant was perfectly fine. You just kept putting money in your 401k. Your 401k was managed pretty well, and you didn't have to worry about it. Eventually, you recovered. Come today, especially with retirement being so close, with taxes changing, you got to be an active participant, because the professional players, right? There's a saying, right? Nobody got fired for buying IBM, right? There's a lot of that happening right now. What that means is that people are doing what is the non-suable choice, right? The thing that you can't come to them and say, you mismanaged my portfolio. They're not doing the right thing. They're doing the thing that they can't be sued about. And so you need to take some more active control, because a lot of the big professional advisors, especially the bigger they get, so people who are managing mutual funds, people who are managing huge amounts of mutual funds, so anything like BlackRock and Vanguard and Fidelity and whatever, right? They can't afford to be sued by a 401k for taking on too much risk. So they're doing things by the book. And the book is wrong this year, right? Because the book that has been correct for the last 20 years, and the truth is the book that was correct for most of the last 40 years, did not anticipate a market that we're in today, right? It hasn't happened before. The Wall Street Journal just today, while I was preparing for this podcast, the Wall Street Journal said that we haven't had a bear market that has lasted this long since 1973, I think, right?
Wow.
Yeah. We are, and that's 50 years. So we are talking about things that have not happened before, that are not baked into all these rules and all of these regression analysis and all these statistics. It really doesn't matter if the statistics say something, but if something wasn't part of that population, if that wasn't something accounted for, it doesn't matter, right? And that's what we're experiencing right now. So you need to think a little bit. You got to be an active participant, not a passive participant.
It's really interesting. If we've learned nothing else in listening to your podcast, we know this one thing, that everybody's situation is different. There's some high-level commonalities. However, knowing that, I still have to ask you this question. What do you recommend that your clients do? How do you recommend they invest their money, especially if they're intending to do it in retirement?
So when it comes to investing your money, I think that you need to look at what investments you're holding. I think more important than ever is you got to look at it first from a time perspective, right? Just to make it easy on yourself, you got to separate your investments out and say, this investment is for what I'm going to live on for the next year or 2 or 3 years. This is investments that I'm going to live on in 3 to 5 years. And then this is the investments that are long-term into the future, right? This is what I'm going to have a future from. And you need to separate those out, right? Because the decisions that you make for money that you're spending tomorrow is different than the money that you're investing for 3 or 4 years or 5 years, right? And it's certainly a lot different than when you're investing for 10 years from now, right? Because from 10 years from now, we got statistics on our side, right? What's happening right now in the economy, what's happening right now in the stock market, right? It's going to be a blip. Right. Even when you look at 2008, like no matter what happened in the market, no matter what time period you look at, 10 years, right, it not only recovered, but it grew. Right. Generally speaking, you can take on more risk in that when you're looking at that 10-year bucket. But when we're looking at the near term, right, up until now, you didn't have much options, right? So people were putting it into bonds and things to grow interest rates, or they were leaving it in their checking account. Now you need to find either a checking account or a money market account that's paying 5%, right? Or close to that, because you need your money to grow at least close to inflation, because you need to be able to you need to buy the same goods. You need the same bread and milk and eggs. I don't know if you've seen the cost on eggs have skyrocketed. So yes. You need to be able to afford these life essentials. And so you need your everyday money to grow. And then the things that are 3 to 5 years, right? Hopefully the market will recover in 3 to 5 years. I think it will. But you need investments that are designed for 3 to 5 years. They can have more volatility, but not that much because you're going to need them. So that's where maybe if you want to have those CDs, right, that are paying 6-7%, if you can find them, right, maybe have some equity in there, you can take those investments on. But I think looking at it from time horizons is really important right now. And then making sure you're taking on appropriate risk for the future. So I think they throw out that 60-40 idea and just look at a time horizon.
Interesting. So tell me, how does Johnny Lunchbucket navigate this? How does the savvy investor navigate this, especially if they want to do it on their own? If they do, how do they go about it? Or should we just say, no, I'm just going to talk to Label or somebody like him?
So I think that it depends on, I think it really comes down to how good you feel about your decisions. Will you be questioning your decision all the time and whether you're making the right move? Or will you have confidence that, no, I made the best decision and you're not going to worry about it, right? If you're someone who logs into your bank account every day or even once a week, then I highly recommend that at least just for the next year or two, get yourself a financial advisor, even a fee-only financial advisor or a financial coach, someone who can talk you off the ledge from selling at the wrong time. Because it's going to be a crazy ride. No matter what happens, I can guarantee you this, the next 24 months is going to be a wild ride, right? Because we have right now what's happening in the economy, and we have this war with Russia and Ukraine that is about to really take off as their winter comes to an end. So we have the repercussions from that. The market will hopefully recover by the end of the year, right, and stabilize somewhere. But based on the numbers that we're seeing, that's not a certainty. And then we get into the 2024 election cycle. And you know that's going to be a hot election because you've got a polarized country, you've got an economy that's all over the place, and we have the Tax Cut and Jobs Act that's going to affect so many people. So we know it's going to be a contentious election. And then we know that whatever happens the first year of the election, there's going to be something about this Tax Cut and Jobs Act that takes place. All of that affects the stock market. So for the next, really, until we have some clarity as to who's going to win and what the agenda is, it's going to be a very bumpy ride. So you need to have a plan for that volatility.
So what do you have for us at yieldsforyou.com that can help us to think through these points that you just raised?
Go to my website, get that 321 retirement plan. I walk through step by step how to implement this in your life, in your retirement, so that you can create those different time horizons, those different buckets, how you should look at it, what are the important decision-making factors when you're making these decisions. So go through that. I highly recommend it. And then if you go through that and you're like, I need some help on the investment side. I need some help on this side. I have classes on each of those specific topics that you can take a look at on our website. But start with that 321 retirement plan. That's where you want to start. That is the basis really for making all these decisions.
The website is yieldsforyou.com. Yields, the number 4, the letter U.com. And it's just a wealth of information at Label's website. Do yourself a favor and stop there. Do you have a final thought? We only have 30 seconds.
Final thought is that at the end of the day, the only thing that really matters is that you get to enjoy your retirement, right? Forget about the stock market, forget about anything else. You need to have a plan to enjoy your time, right? And so when you're making your retirement plan, when you're making your investment plan, that should be front and center and everything else should follow.
Makes a lot of sense to me. That's all the time we have left, Label. Join us again next week, everyone, as we talk about what we have in store for 2023. You don't want to miss this one.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com. That's yieldsforyou.com. Or call 410-914-4894. That's 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.